Bitcoin only.
Bitcoin mining.
Bitcoin miners.
Bitcoin.
These AI agents and AI coins, you've got the OGs like GOAT and Fartcoin, of course, but then, got AIXBT, AI16Z, like all these different coins that really kind of bring in the incentives of AI and sort of align them across an ecosystem, that ecosystem being the token, of course. It's very, very interesting. And it allows you to get exposure to AI in a way that was never really possible before. The thing about liquidity, it's kind of a catch-22 or somewhat paradoxical, because the only way to get liquidity is to get more liquidity.
Welcome to the Decoded podcast, where we bring you stories from founders and investors in Web3. Before we get started, this is not a financial or legal advice. It's just a conversation about things we find interesting in Web3. Views expressed are our own personal opinions. Decoded members or guests appearing on the show may have positions on assets they talk about.
All right. Today we have Nick Hansen, the CEO of Luxor Tech or Luxor Mining. Welcome to the show, Nick.
Yeah, thank you. Thank you for having me. Looking forward to chatting about several topics today. Lots of interesting things going on in the Bitcoin mining world. And I think you've got a good list of topics for us to cover here. So looking forward to it.
All right. Before we jump into all of that, I have a couple of questions. One is, what coffee is that? And
yeah, so my wife got me an espresso maker. This is actually a Longo, and it's great. It's early here, so trying to be flexible and getting a couple coffees in this morning. I don't know the type. I think it's just regular. I don't know the brand of coffee, but yeah, I'm not a coffee snob. It's just, it does its job for me.
all right, because Joel and I are sort of coffee snobs, and
Okay.
we have an office in Dubai where Joel has like stashes of coffee. And last time I went there, he made a nice V60 pour over for us, which was incredible.
Okay.
So yeah.
Nothing that fancy. This is an automatic espresso maker. It does grind the beans and everything, but there's no science to it. Like some of those guys, they really get into the coffee.
All right. Shout out to Web3 Lord for setting this up. Thank you so much, man. He's been a friend of Deco since a long time and appreciate all the help. He sent me a picture of yours. I think it was a profile picture where there was a bike, a two-wheeler, and your name on it and number 600. So are you into racing or anything? What's the
Yeah,
story?
so that is actually the front number plate of my dirt bike that used to be my dirt bike. When I was younger, I started riding dirt bikes when I was like 10 or 11 and was really into it. Like me and my family, we would travel all over the United States and race, and actually it was quite good. There was actually an inflection point in my life. I was actually probably going to try to race dirt bikes as a career, and that would be my job instead of what I'm doing now. But then, of course, I crashed and tore my ACL, which is the ligament in your knee. And then, pretty much at that point, it was like I never got as good. I kept riding after that, but never was as good after that. So anyway, and then as I got older, there were a few other crashes. Maybe when I was like 24 or 25, I fell pretty hard. And, at that age, I was just like, oh, my whole body just hurt. So I ended up hanging it up. And so now I'm just a fan. I watch the races on Saturdays. So I watch the races every week, but I no longer have a dirt bike because as somebody my age, it is hazardous for your health.
Okay, from there to Bitcoin mining, how did that journey pan out?
Yeah, so Bitcoin mining is something I was always interested in. Actually, around the time I was hanging up the dirt bike, I started learning about this online currency that nobody owned and nobody made. It just came out of nowhere. I didn't really know how it worked. And so I was really interested in that. And so I got into Bitcoin actually through the mining ecosystem. Really didn't understand exactly what was happening, but I learned that you could build these computers and they would go out and do some computation and you would earn some currency for it. So as of course, learned more about how the blockchain worked and how new blocks were mined and all of that. So I was building GPU Bitcoin miners back when you could do such a thing, kind of at the end of 2013. And actually right around that time is when the very first ASIC started getting built. A company called Butterfly Labs produced an ASIC called a jalapeno. It's like this big. It was like the size of about big tungsten cubes, like a 4x4. And it did like 350 gigahashes, which is crazy. So GPUs, one GPU, like a 59, what I was using was called an AMD 5950. And that thing would do somewhere around, let's call it 120 to 150 mega hashes. So a mega hash is a million hashes. And then this little box that's like this big, GPU had these big GPU rigs, and this little tiny box like this big was able to do almost 30 times that. So 350 gigahashes, which is billion hashes. And I was like, holy, these are going to change everything. So I bought some. Of course, Butterfly Labs ended up being a scam and they did never ship. Or they actually did ship. They just shipped super, super late after they had already, all the profitability had been squeezed out. So anyway, over time, just continued to learn more and get invested in different mining machines. I was very young at the time, didn't really have any skills per se, other than, I was a software engineer, but a very junior one. So I was working at a real job, and, over the course of a couple of years, just, faded in and out. I got washed out pretty bad in 2014. That bear market was pretty brutal. And then around 2017 is when the next bull run kind of started, and I had built up enough skills where I was like, okay, I'm going to go try to build something in this ecosystem. Build some software, instead of hardware. Hardware's hard. Software is a lot more scalable. I actually started building something for a crypto called Siacoin. Basically, it's like distributed file storage. And what I was thinking, I was like, okay, Siacoin, really cool technology that allows you to basically break up and distribute all of these storage shards to be stored on different computers. And it's not actually the storage that's going on the blockchain, it's the proofs that somebody is actually storing the thing that they say they're storing. So, if I have a terabyte, I put the terabyte of storage on my disk, and then I'm serving proofs to the network that I'm actually, storing the data that I say I'm storing. So what I started building was an S3 wrapper around that. So S3 is basically anytime you interact with Instagram or whatever, it's an Amazon service that is a big standard set of APIs for getting and retrieving files. And so basically what I was thinking was like, I could build this wrapper around Siacoin that allows you to interact with Siacoin in a way that is S3 compatible. Turns out that doesn't really work because Sai was not really ready to scale to that size, but it was really cool because it actually introduced me to my co-founder, Eddie Wang. So Eddie was also very interested in Siacoin, found the GitHub repository that I was kind of working on. We connected and he was like, hey, I know how to build front ends. So he started building a website for this. And I was like, oh, this is really great. Yeah, we together learned that Sia would not really work. And we're like, well, what else is going on? Well, at the time, Siacoin had 98% of all of the mining compute power, the hash rate, on a single pool, which is obviously very bad for decentralization. That pool was run by a respected community member and all of that. But at the end of the day, all the hash rate was on a single pool. So we started trying to build a mining pool for Siacoin. And that started Luxor mining. So we started this mining pool. Eddie built a UI for it. People started using it. And we're like, whoa, this is kind of cool. We actually got some real users. But during that time, it was just a hobby project. We were working on it nights and weekends, the same time people would go golfing or, go hiking or whatever. We were doing our hobby, which was building this pool. But over time, we started building a few more pools, Decred and Monero and Zcash, and got to a point where we're actually building like a lot of pools. We have a lot of customers. And we got to a point where we actually had some real revenue. So then in 2019, I actually made the decision, like we actually have a real business here. I'm going to go full time. So I quit my easy Silicon Valley job, software engineering in Silicon Valley, and then went to work at Luxor full time in 2019. And pretty much have been off to the races ever since. So we started with a Bitcoin mining pool, built a whole suite of products since then. We built, LuxOS, which is firmware. Basically, it's the software that goes on the mining machine itself. It's kind of like jailbreaking an iPhone. We build financial products for miners. So the same way that corn producers and oil producers are able to hedge their output, for a given season, we do the same thing, but for miners, they're basically able to hedge that. We buy and sell mining machines on behalf of our customers. So we call that our ASIC trading desk. The same way you need to go buy a bunch of shipping containers or, a bunch of stuff from international. We import that, we bring it in for our customers, distribute it. We have a whole logistics team for that. Yeah, so that's kind of the advent of Luxor. Sorry, it's a little bit long, but that was the advent of Luxor, kind of how I got into it and, which coin, where I started. But now really almost entirely a Bitcoin-focused company. I'm a Bitcoin-focused person. I'm a financial Bitcoin maxi, but I do find a lot of the other stuff that's going on in the world really interesting. A lot of the other crypto is really interesting, but up to now, I really only hold most of my financial wealth in Bitcoin. So anyway, that's me. That's Luxor.
No, that's super interesting because most of the people, they start with Bitcoin and then they diverge and go into all kinds of things, right? I mean, but here it seems like the other way around, where you started with something like a Sia coin and then arrived at Bitcoin.
Well, I have been around a little bit longer.
Of
So
course.
maybe most of those people are halfway through the cycle like I did. So I started with Bitcoin only because that was the only thing you could really mine at the time. And then all these other coins, when Bitcoin was moving to ASICs, they started calling them ASIC resistant coins. So they were all like GPU mineable. So everybody that had GPUs could mine these coins. Actually, Ethereum used to be a GPU coin, actually all the way up into the merge. So anyway, I was Bitcoin only. And then I was like, okay, well, I can't do Bitcoin anymore. Maybe I'll try like Litecoin. I started mining like Litecoin and Dogecoin, Feathercoin, all these coins that were GPU mineable because I had, 15 GPUs in my basement. And I got washed out which is kind of part of the cycle where everybody gets washed out of their altcoins, realizes Bitcoin's really the only one that has any lasting power up to now. And then they go back to Bitcoin. So I'm kind of in that third phase of the crypto journey.
Now, only since you mentioned that you keep in touch with the rest of the market as well, what are your thoughts on what is currently happening with the whole crypto cross AI stuff?
Yeah, I mean, it's super interesting to me. I am very cautious of AI. I think that AI could be highly, highly disruptive to the way that we live. I'm actually rereading a book called The Wealth of Nations, which basically outlines, division of labor, all this stuff. And it's from 1762. The book is basically the underpinnings of our current financial markets. Like I said, division of labor, all that stuff. And I'm rereading it kind of through the lens of AI agents and how drastically all of the things that we built our entire world economy on could be disrupted by that. So anyway, very interested in AI and how it's going to disrupt things. These AI agents and AI coins, you've got the OGs like GOAT and Fartcoin, of course, but then, got AIXBT, AI16Z, like all these different coins that really kind of bring in the incentives of AI and sort of align them across an ecosystem, that ecosystem being the token, of course. It's very, very interesting. And it allows you to get exposure to AI in a way that was never really possible before. If you wanted to get exposure directly to AI as a financial tool or asset, it's really hard to get. You can't really just go buy OpenAI stock.
You had to be a VC.
You have to be a VC investing in these early stage companies. This is a way to kind of democratize that. So I'm actually pretty open to it. I mean, obviously it's rife with scams and rugs and all that stuff. So you got to be very, very careful. But I do like the idea that this is democratizing the AI ecosystem financially, especially. So it kind of aligns the incentive of AI with somebody that can actually, participate effectively, trustlessly. You can go buy the token today and get exposure to AI in some way. So I like it in concept, of course. Be very careful if you're out there in the AI trenches now. The AI agent trenches are rife with scams. As soon as a meta like this pops up in any facet of crypto, there are tons and tons of scams that pop up around it. So be very careful if you're out there looking at AI agent coins and trying to be involved. But I do think it's a really interesting thread.
Brilliant. Wealth of Nations is, I think, by Adam Smith, by the way.
Adam Smith.
Yeah.
Thank you. Yeah, Adam Smith.
Super interesting. I like that you keep in touch with the rest of the market as well. And
it's
not just with. And I'm curious about, while you were talking about Luxor, you also mentioned that you did not want to get into something that is hardware heavy pretty sure that any mining business requires upfront capital expenditure. So was that a gradual transition or a switch just flipped in your head that, okay, this is where I need to go?
Yeah. So at the time when we were building Luxor, it was just, like I said, it was just Eddie and myself. We were, I don't want to say we were poor, but we didn't have hundreds of millions of dollars to go build these massive data centers. We're thinking what can we do to get off the ground? And so we started building, software. If you have the ability, if you have a laptop and you know how to code, you can start building a product that people can interact with all over the world. So we really focused on the software side. And now, fast forwarding, 5 or 6 years from that time, we really are glad that we did, because there are folks that are specialists in going out and raising capital to go invest in these things. And those folks end up being our customers. So if we were really focused on what you call prop mining, proprietary mining, or self-mining, basically mining for yourself, we would be, effectively competing with our customers. Every machine that we add to the network would reduce, the earning potential of all of our other customers. And there's always going to be this bug in the back of your mind. If you're one of our customers, like, oh, Luxor's not giving us the best. Like, they probably have way better stuff underneath the hood if they're out there doing this big self-mining operation. They keep all the best for themselves, and then, they give us, whatever's left. So very happy that we stuck to a very software-focused services business where we're basically servicing all of these customers, providing value across the stack, but not actually competing with them. And really, like I said, the reason that we did that is it's not our area of expertise. And I'm glad that we made that decision.
Awesome. Now let's get into the actual discussion. And I want to ask you a very, very probably stupid question, but something that I felt is logical. I have seen these takes by pretty large accounts on Twitter, which claim that Bitcoin price has some sort of a bottom because there is a cost of production associated with it. In a simpler manner, they are trying to state that price follows hash rate. Whereas I think that's not, price doesn't care what the hash rate is, right? Price is price and everything else follows price. So I just want to know what your take.
Yeah, so big runs, we call it price discovery. Basically, when you're all-time high or exceeding all-time high, you're basically in price discovery, discovering what is the new price of this asset going to be. It happens in all asset classes, but the one we're talking about here is Bitcoin. Gold actually has been kind of in price discovery over the last year or so as well. But anyway, I'm very convinced, and I can actually explain kind of why this is, that hash rate follows price. And here's why. So when price rips, let's say Bitcoin, this last year, Bitcoin went over 100K, increasing by over 100% year to date. What that means is that anybody that holds Bitcoin now has a lot more money to go and invest and buy infrastructure and do all the things necessary to build Bitcoin mines. So more hash rate comes online. It also increases the profitability of that mining, so the return in investment into Bitcoin mining looks really attractive when Bitcoin's at 100,000. So people start funneling money into buying hardware, buying transformers, buying land, securing power purchase agreements, all of that stuff to go and capture this really attractive ROI potential. And so then the hash rate starts to rip. Basically, more and more machines come online. I do think, though, that it does start to introduce a bit of a floor. I don't think it's not a hard floor. It's not like the floor is the cost of production, because we actually saw over the summer of 24, it was actually the all-time low, what we call hash price. Hash price is the dollars per petahash that you make per day. We actually saw that right now it's at around 60, maybe high 50s to $60 per petahash per second per day. Over the summer of 24, hash rate was continuing to rise.
Just a second. Basically, that is the number of Bitcoin that you can mine multiplied by the price on that day.
Yeah, basically, more or less. The transaction fees, there's a couple other things that go into it. More or less, we just try to normalize around this number of dollars per petahash per second per day. Petahash is a unit of compute power. Actually, in terms of the earlier example, I was talking about GPUs doing mega hashes and this ASIC doing gigahashes. Well, most ASICs nowadays are in the order of terahashes, and a petahash is even one more magnitude than that.
Right. So 10 raised to 15 is peta, 10 raised to 18 is hexa. That's where we are current. Right.
Yeah, exactly. Yep. So it's billions, quadrillions. So ASICs nowadays are doing quadrillions of hashes per second. And then like a couple of ASICs now is doing like quintillions of hashes per second, which is crazy. So anyway, so petahash per second per day. Actually, this summer, we saw an all-time low hash price in the mid 30s. So, actually mining economics are almost 50% better than they were over the summer of 24. But hash rate was continuing to rip. So anyway, but I think what we see, as I was kind of starting to mention, is that you do see a bit of a floor because of increased hash rate across the network. And the reason for that is miners are one of the larger holders of Bitcoin, and they feel like if hash price is really low, I'm not capturing a lot of margin, I really just need to hold the asset and speculate. Miners at the end of the day are great holders of Bitcoin. They hold a lot of Bitcoin. And, in the early days of, of Bitcoin's life, you could actually, build trading strategies around movement of miner coins. If miners were being forced to sell, you knew this was sort of a capitulation event because they're sort of the holders of last resort. And so you're like, this is, we're kind of getting to the end of probably at that point, if you're looking at on-chain metrics, the end of a pretty long bear cycle. That doesn't play out as much anymore because the mining emission has reduced so much. We've mined around 19 million coins. There's only ever going to be 21 million. So there's only a couple more million coins for miners to go get. So the bags miners have been packed for a long time. And so that meta may not persist as much. But I do think it does set a bit of a floor, but it also hash rate definitely follows price, mostly because of the capital expenditure required and price allowing miners to get more liquidity and basically go reinvest. So anyway, hash rate follows price.
How big of a factor is electricity costs when it comes to looking at your operational expenditure?
Yeah, it's the number one cost. So most miners, so right now I would say, actually that was another big thread. The previous bear cycle, basically energy prices were drastically elevated because of the conflict with Russia and Ukraine. That caused natural gas prices to increase across the world. You heard stories of like Europeans paying $400 or $500 a month just to heat their apartment. That was because of natural gas prices increasing so significantly. That caused a lot of strain on Bitcoin miners. So Bitcoin miners' number one expense being energy cost. A lot of times that energy comes from natural gas. So during that time, they were feeling a lot of compression of their margin. Basically, they were paying a lot for energy, not making a lot from their Bitcoin mining. So a lot of miner capitulation. The energy costs nowadays, I would say we measure it on a kilowatt hour basis. So I would say right now, the over under on Bitcoin miners is somewhere in the 5.5 to 6 cents per kilowatt hour range, which is a really good power price. here at my house, I pay like 10 cents, which is actually one of the lower in the United States. I'm in Washington. Most folks around the US are probably paying more in like the 12 to 17 cent per kilowatt hour range. So Bitcoin miners are going out and finding really cheap pockets of power, but the best Bitcoin miners are finding power in like the low fours, maybe even the high 3 cents per kilowatt hour range. So that's definitely the number one fast factor when deciding whether a Bitcoin mining deployment makes sense. Folks nowadays are looking towards, new miners are looking towards places like Ethiopia, Kenya, Nigeria, Paraguay, Brazil, Venezuela. Those are all places where there's a lot of latent energy, energy infrastructure that's been overbuilt and is being underutilized. So miners are like, I can go get that power for super cheap. You just take a little more risk. Obviously Ethiopia, rule of law, things like that can be a concern. So more tangibly, if I invest $100 million in an Ethiopian Bitcoin mine, how do I know in 5 years that I get to continue to own that asset? It's not been taken over because of a government change or whatever. In the US, more, areas where there's more rule of law and consistent governance, you're reducing that risk. So a lot of folks invest in the US for that reason. But anyway, that's a little bit about power pricing and kind of how power pricing around the globe affects where Bitcoin miners deploy.
And, as you mentioned, right? There were GPUs earlier. Now there are ASICs, and ASICs also keep improving every 2 years, every 4 years. What does that look like for a miner who's continuously like mining Bitcoin? Like how frequently do they need to upgrade? What does that supply chain look like? Are there delays? Like how do you negotiate ASIC contracts and even energy contracts with energy providers?
Yeah, great question. So Drew Armstrong from Cathedra Mining is a publicly listed miner, a smaller one, but publicly listed. Anyway, he came up with this idea called the mining hamster wheel, the miner hamster wheel. You're basically always having to think about the next cycle of machines. Machines do last longer now because we are getting kind of towards the end of Moore's law, or Moore's law is not holding up as much for miners anymore. They've kind of reached the threshold of efficiency. That doesn't mean there isn't efficiency to be gained. In the early days, new miners were coming out every 6 to 12 months. And so if you were investing in mining, you had to be thinking about that, like, man, I'm only going to be able to, at the time, there was a miner called like an S3 or an S5. You're like, if I buy this S3, I need to be thinking about the S5 like within 6 months. And then the S9 came out. The S9 lasted quite a long time. The S9 was the prototypical miner from like mid 2016 to 2017. That was like the standard. Everybody was deploying S9s. So you plug in all these S9s, and they actually lasted quite a while. They had an S11 and an S13, but they weren't that good. The S17 was really the next model, and it wasn't great. It wasn't the best. The next big, the prototype model that everybody uses or is using and kind of phasing out now is the S19. The S19 came out in 2019.
I think it's either 20 or 21.
It was the summer of 2020. Yep, I was thinking because it came out actually during the last big hash price bear market, and that was the summer of 2020. And so that was actually what Marathon, the biggest miner in the US now, they went and put down a big order on S19s. And everybody's like, oh man, what are they doing? These S19s are super expensive. Bitcoin hash price is at an all-time low. Well, fast forward a year later, Bitcoin mining has been banned in China. Marathon now has the biggest fleet of the best miners, and they basically use that momentum to become what they are today. So they timed the market perfectly. They bought the absolute best at bottom barrel pricing, and off they went. So S19s are still in production today and are still being utilized by most of the biggest miners here in the US. But we are starting to see a transition to the newest model, the S21. So the S19 was a great model. The S19J Pro is a submodel of S19 that's basically the S9 of this cycle. Folks are taking them off the racks now, but they've been around for a long time, so 4 or 5 years now. And so the new model is the S21. But you can see now we've made it, the S19 was very profitable all through that entire time, except maybe last summer was when they kind of reached the bottom of their profitability curve. But now we're, 5 years later, getting into the S21s, S21 XP, S21 Plus, S21 Hydro. All these have better efficiency. Oh, and I guess a little on efficiency. So the S9 was around 100 joules per terahash. Basically, joules is the energy component. And so you basically, that number as it decreases means your miners are more efficient. You're using less power for the same terahash. S19s were somewhere in the like mid 30s. There were models of S19 that got down into the 20s joules per terahash. Now the S21, the mid teens. So like, somewhere in the 14 to 16 range. There is rumor of a machine that's going to be sub 10 at the end of 2025 by Bitdeer. Bitdeer is the company owned by Jihan Wu, the original godfather of mining. And that is called the seal miner. That could potentially be the first machine to break the 10 joule per terahash mark. But I don't think Bitmain is going to take that. They're not going to take that lying down. They're going to have a model out as well. So we'll probably see 10 joule per terahash by the end of 2025 here. So anyway, that's another long-winded answer about miner models and efficiencies over time.
Right. Right. So now there are two more variables that I think are the most important. On the input side, it is your cost of energy. And on the output side, it is, of course, like the BTC price itself, right? I mean, it determines what the miner profitability looks like. So one question is, how do you negotiate your energy contracts? That is one on the input side. And on the other side, can you talk a little bit more about hash rate futures and how that is going? Because that allows you to, even though, I mean, if the Bitcoin price fluctuates a lot, that as an instrument can probably allow miners some sort of a relief. Like it is analogous to an oil manufacturer playing around with like oil futures.
So energy negotiation, that's definitely, it depends on the jurisdiction. So it depends where you're actually acquiring that. It's called a PPA, power purchase agreement. So a lot of companies, most companies right now in the US are deploying into ERCOT, which is the Texas grid. You can go get PPAs there. And really the negotiation for that is very, it's very transparent. The thing is, those PPAs are expensive. You have to put down a lot of capital to secure them. And so most miners actually end up, they call it riding floating spot, basically taking whatever the market gives them, because generally that's going to be less expensive than if you take the cost of that capital you have to put down as a deposit with the power producer to secure that PPA. So it's generally cheaper to just float spot. Also, but that does introduce a lot of variability. So what we see then, instead of miners securing PPAs, is actually floating spot and then curtailing. So curtailing is, that's kind of the current theme in mining, and that's responding to changes in market dynamics. So if you're floating spot, you're 95% of the time, your energy prices say very, very low, 3 to 3.5 cents per kilowatt hour. But then in that 5% of time, it can spike. Like right now in ERCOT, they're going through, it's very cold in Texas, colder than it usually is. So there's a lot of demand for power. People are turning on their heaters, all of the things that we use. And also there's lower energy supply, meaning the wind turbines and solar panels are not producing as much energy as they used to, or as they usually do. And so what that means is now, power has gone up to like $20 a kilowatt hour. So it's up like over at like 1,000%. So what that means then is that miners, they turn off, they curtail. So they ramp down their operation. And so instead of buying that power at, 100 times their normal cost, they just turn off. And so really now the best miners in the country are making short predictions basically, 5 to 24 hours into the future, and deciding whether they should turn off their machines or not. And so the best miners are able to do that really seamlessly. Now it's starting to pair that with hash rate hedging. So they know that they're going to have to turn their machines off, but they would like to continue to get exposure to hash rate as an asset class. And so they can go and buy hash rate from Luxor or from other markets and basically still get the exposure during those intervals, except for they don't have to pay the operational cost where they're located.
Essentially, they are getting exposure to hash rate where the operational costs are still lower, right?
Exactly.
Right.
Yeah, exactly. And so these hash rate markets really have been developing over the last couple of years, mostly at Luxor, something we sort of pioneered. There are other folks that do it. What we wanted to offer was the ability for miners to offset or reduce their exposure to that, but they actually want more. We realized that miners, degens just like the rest of us, and they want to get more exposure. But the original idea was that they would be able to sell forward, say, 12 months of mining exposure and reduce their exposure to volatility in the market. I mean, there are miners that are doing that. There are miners that are definitely thinking that way. We're calling it the hash spark spread. If you've ever heard of, like in petroleum refineries, they lock in this thing called the crack spread. Basically what it is you input oil at a certain cost. The refinery breaks down that oil, turns it into gasoline and other petroleum byproducts. They know that there's a spread between the two costs of those, and they call it the crack spread. So they lock in their oil price, they lock in their, let's just call it gasoline, their petroleum price on the way out, and they lock in that spread. We're doing the same thing with miners. Basically, we call it the hash spark spread. And that is energy cost in. If you can hedge that, and then you hedge your output, you now have a locked in price or locked in margin on your mining operation. The reason that's really attractive is it makes you much more financeable. So somebody that wants to issue you debt, they no longer have to look at the price of Bitcoin hash price and energy cost. They know that you've locked these in, so they can issue you more debt. that allows you then to go buy more machines and become more competitive in the market by buying more machines, locking in better PPAs, buying more infrastructure, all of that stuff. And so it just makes you more financeable. And that's what we started to see, over the last, call it 6 months, miners really starting to explore how they can become more attractive to the credit markets. And that includes, hedging various aspects of their business. And those are the types of products that we're trying to bring.
Thanks a lot. I mean, that was super helpful to me because, fine, you understand all of this in theory, but it's different when you're talking to an operator who does this day in and day out. So are there what does the liquidity look like for these hash rate futures? And can anyone go and bet on them, or what's the
Great
process?
question. Liquidity is the hardest, in DeFi world, we're out in DGen world. Liquidity is king. Is your coin liquid? Are the markets you're operating in liquid? And the thing about liquidity, it's kind of a catch-22 or somewhat paradoxical, because the only way to get liquidity is to get more liquidity. And so it's like, where do I start in this life cycle? So for us, it's just been a long process of getting participants comfortable with the markets and realizing that there is a clearinghouse for this market. And yeah, so for us, really the number one goal for Luxor has been how do we build liquidity in these markets? If somebody wants to come in and lay off, let's call it 3 exahash for 30 days, 3 exahash generates around, let's call it $200,000 per day. If somebody wants to do that for half of the year, that's a pretty big contract. That's, a $30 million contract. So that's a pretty big depth. So we need to have somebody that wants to buy that side if somebody wants to sell that size. So we've been developing that. We do have, several exahash now on both sides of the market, several exahash of buyers, several exahash of sellers for various different lengths. As to your question about whether folks can come in and participate, unfortunately, this is a highly regulated market. We are clearing financial contracts. So you have to be at what's called a qualified contract participant, and you have to be able to sign an agreement called an ISDA. And I don't remember what ISDA stands for. It's a very standard template, but it does basically outline all of the default parameters, what happens if somebody doesn't deliver all of that stuff. So it's not very easy for what I would call retail. Even myself, I can't participate as an individual. It has to be through Luxor. And so it isn't very easy to get access. Now, we would like to be able to bring that to more the retail base and to other folks that would like to participate that aren't qualified participants. It's just we don't have the regulatory framework to do that right now. Luxor's always been very focused on we don't want to be on the wrong side, especially the US government, but other governments around the world. So we've always been a little extra cautious, especially when it comes to these types of derivative products. Derivatives are certainly an area where there's a lot of gray area. And so we want to make sure that we're very securely in the free and clear zone as opposed to trying to operate in kind of the gray area. So that said, yeah, it isn't easy for retail participants to get involved right now.
I mean, probably I can imagine a world where hash rate futures trade the same way oil futures trade on exchange and whatnot, right? But
yeah, so we do actually have a futures listed product. It's not terribly liquid yet, mostly because most folks need, the reason we think that it hasn't really gotten a ton of liquidity is because we think most miners are looking for bespoke tenors. What I mean by that is a miner wants to trade for 45 days. Well, there isn't a contract for that. It's a 30-day contract. So a miner wants to trade for 45 days or 90 days or some bespoke tenor. You basically have to go out and find somebody that wants to take the other side of that trade at the same tenor. And that requires us to go actually create contracts specifically for that particular trade. It's called in that case, it's called a swap. But we do have a futures listed product on our partner exchange called Bitnomial. Bitnomial is a competitor to CME, which is a commodities exchange in Chicago, regulated by the CFTC. So we do have a regulated, CFTC regulated exchange traded product. Just it's not the one that most people use right now. They mostly use the OTC markets.
All right. A little bit about energy again. I mean,
okay.
It is logical that, it's said that Bitcoin forces you to find renewable sources of energy, which are likely cheaper than other non-renewable sources of energy. That is one. Second is, you can provide the energy to the grid when the requirement is higher instead of drawing and so on. How real is any of this until now? And for this to be, what needs to happen for this to be prevalent across the globe? Because I know that there are parts in India, for example, there is a part called Kutch in west, a state called Gujarat. It's not habitable. I mean, the temperatures are pretty high and, it's difficult to build sustainable neighborhoods in that area. But of course, I mean, all that solar energy is going to waste. And Bitcoin as a technology allows us for the first time to go to the source and not carry it where we live, where we suffer from transmission losses and so on.
Yes.
So can you unpack like this a little?
Yeah. It's really the biggest trend in mining. Probably it'll be the biggest trend for the next 20 years in mining. So I guess we could start with energy density. So energy is sparse, and what I mean by that is it's generally equally distributed around the world. And the reason for that is the sun, which is our main source of energy, hits the earth. It's been hitting the earth for millions of years, all relatively equally. The same amount of sun hits here as it hits somewhere at the same latitude in South America, but just at different times. All that energy gets captured in different ways. Up to now, it's been captured and put into pockets as petroleum fuels, through biodegradation. Basically, plants absorb that energy and then millions of years ago died and created pockets of energy, petroleum, that we're able to use, and it's very dense. But we've started to, as a civilization, realize that we can actually capture that energy directly from the source. Okay, so anyway, that's the sparseness of energy. So what miners have been doing up to now is finding these pockets of dense energy that's what we call stranded, basically unusable because of the transmission costs that you mentioned. It's actually you lose a lot of energy. If I transport energy from LA to New York, you would lose 99% of it in the transmission lines because of transmission loss. So if for whatever reason, energy was very cheap in New York and not cheap in LA, it may not make sense, even though, in theory, it might make sense. You're like, oh, it's very cheap here, I should get it over there. You can't really do that because you lose so much energy across the line. Now, Bitcoin miners have identified, I can just put my Bitcoin mine next to the cheap source of energy and utilize it there. And right now, the cheapest sources of energy are renewables, because effectively there's zero cost. Once you've paid for the expense to build the solar farm, to build the wind farm, or hydro dams are great. It's effectively zero cost. So Bitcoin miners have started locating there and monetizing what we call stranded energy sources. So some of the biggest trends in mining right now are miners moving to Paraguay on the Ayatapu Dam. It's a 13 gigawatt dam, and they massively overbuilt this dam. And so Paraguay ends up selling most of that energy to Brazil for less than a cent per kilowatt hour. Bitcoin miners have come in and they're like, we'll pay you that's 3 times more than you would make selling it to Brazil. And that's still 50% less than what I would consider the average of the network to be. So miners have identified this is a great opportunity for us. So they go to Paraguay, they plug into the dam and pull energy off there. The same thing's happening in Ethiopia. They massively overbuilt. They have a big hydro facility there. They can go put miners there to monetize that energy that otherwise would be left to waste. In the case of intermittency, so we talked about energy sparseness, but now energy is also somewhat intermittent. What that means is sometimes it's daylight, sometimes it's daylight, sometimes it's nighttime. And at night, solar panels obviously produce zero energy. So there's no energy supply during that time. And so miners are basically allowing us to overbuild and use up extra energy. So maybe Texas is a great example because they have a ton of renewables, and renewable introduces a very dynamic demand curve. Demand curve is the amount of energy being consumed and the amount of energy being produced at any point in time. And miners, really hard thing for a grid do is it's called grid balancing. It's basically reducing the amplitude between the peak and the trough of this demand curve. Miners are able to turn on at the peak, reduce the amplitude of the peak, and then they turn off at the bottom and reduce the amplitude of the bottom of this demand curve. If I'm a person living in an area that has a big demand curve, if it's really cold out, I don't really care what the cost of energy is. If I want to keep my family warm, I'm going to run the heater and I need to use that energy. So I'm not going to curtail my energy consumption. Also, hospitals. Hospitals, doesn't really matter what the price of energy is. You pretty much have to keep the power on. So they are not a curtailable load. Bitcoin mining is one of the first loads that is readily curtailable. If the economics of mining move against a miner, they'll happily turn off. There's no reason for them to continue to run because they're just trying to monetize this spread. And so that reduces the amplitude curve. So I guess I went through kind of 2 topics there, basically the intermittency of energy and sparseness of energy. And miners are actually capitalizing on both of these things where they go find really cheap sources of power, but they also participate in areas where there is a lot of population density and reduce the demand curve for that particular region. We see it most in ERCOT because the data is very transparent, but they're participating in other areas, especially in the US, where there is a lot of renewable sources being built, which introduce intermittency on the grid.
But does that impact the break-even period for all the expensive miners that you are buying?
It's part of your calculation when you're running the model for your data center, your new Bitcoin mine. You have to think about what's my uptime going to be. So right now, most miners, if you're in a low uptime environment, maybe you're way out in the middle of West Texas and you're really only running on solar, you're only going to get, say, solar and wind, you're only going to get 70 or 80% uptime. You're most likely only going to send like the oldest machines to that area because you're really only trying to monetize a very thin sliver of time. If you send the latest and greatest machines, S21XP Hydros, you want them to have 100% uptime. More or less doesn't matter what the power cost is, you're going to be operating profitably. So you want to have those machines turned on 100% of the time. So it's just another bit of complexity for miners to think about when they're building out their models is like, how much uptime can I expect? What are historical uptimes? And then you kind of have to make a prediction about what's the uptime going to be in the future. Do I think that next summer is going to be especially hot? It's especially hot. Then my uptime is going to be lower because there will be more periods of curtailment. And so you have to think about that as a miner.
Awesome. All right. Makes a lot of sense. I want to talk a little bit about the fee side, ordinals, taproot wizards, and all of that. So
Sure.
I want to start with, you guys built one of the first 4 megabyte block along with like just putting a taproot wizard with Eric and Udi. So can you tell us what goes on behind like producing such blocks? How difficult is it? And what went down with that?
Let's say it's actually quite easy technically. The thing that makes it complex is you're orchestrating a lot of things and the risks are very high. And so it's technically very easy, but it's very risky as well. So what that means is I'm trying to build a 4 megabyte block or doing some non-standard block construction. There's a chance that I build a block that isn't valid. If I'm a mining pool and I build a block that's invalid, instead of winning 6.25 BTC, I get 0. And you don't know that until you submit it to the network and the network rejects it. So there's a lot of like checks and balances for us to actually determine that this block was going to be successful because we were building a non-standard block. What is standardness? Well, I'm running a Bitcoin node on my MacBook here. Most people, a lot of Bitcoiners run a node at their home or at their site or whatever. Those Bitcoin nodes only accept certain transactions. And there's a whole rule set around them. And what that means is like, if I submit a 4 megabyte transaction, most nodes won't accept it. So you have to change your node rules to accept that. So that was one of the first things we did. We went to the Bitcoin node and changed the rules that it would accept. And then we inserted that transaction, did a couple of verifications to make sure that the block was actually valid that was being constructed by the node. And then it was being broadcast to our miners to go out and mine. And that's why you don't see many 4 megabyte blocks today. It's because miners don't want to take the risk potentially introducing an invalid block. Actually, a good example would be F2 pool. They don't use the standard mempool that's built into Bitcoin Core. They built their own. It's all highly optimized. And what that ended up happening is actually, if you remember stamps, they were kind of like an ordinal. They actually introduced, there's only a certain number of SIG scripts that you can introduce into a particular block. It's basically a DDoS prevention mechanism. And stamps were they were built into SIG scripts. If I recall, this may be wrong. Somebody's probably going to check in the comment or correct me in the comments. But basically, a Bitcoin Core node will reject a certain, basically allow a certain number of stamps into the mempool at a time to be mined. And F2 pool was not doing that. And so F2 pool was submitting during that time. They submitted a few invalid blocks. And you can see them, they go out to the network, people see them, they get rejected by nodes. And so that becomes very expensive. And so that's why you don't see a lot of miners really, or mining pools really participating in these type of like what we call bespoke block construction events. They're very expensive. So for example, if you're mining a 4 megabyte block, you're also kicking out all of the transactions that produce fee for the pool. So you have to account for that and say, okay, Eric and Udi, at the time, it was a very low fee environment, but say sats were, say the fee rate was like 100 sats per VByte, we end up kicking out all of the transactions that pay that much. So you have to pay at least that much. And then also like time and effort and then like some juice. So it becomes very expensive to kick out all those transactions. Imagine trying to do a 4 megabyte block during like the runes frenzy when blocks were filled with hundreds of thousands of dollars of fees, actually millions of dollars of fees. Doing a 4 megabyte during that time would have cost millions of dollars. So there's a lot of complexity and why you don't see more 4 megas. But yes, Luxor was we did the first 4 mega. We can put our stamp on that. And that's definitely an interesting part of Bitcoin lore.
And you talked about runes and orders, and there was a time when fees were high, miners were probably enjoying. But now that is no longer the case. I think the attention has shifted elsewhere, probably AI and all of those things. So obviously, I mean, as the block subsidy keeps getting halved every 4 years, the fees have to increase, right? And I mean, a lot of Bitcoiners, they straight up reject this hypothesis that we need to do something to for fees to increase. I think one of the default go-to responses is, it has survived for whatever years, so it'll do fine, and we probably don't have to do much. In that light, what are your thoughts on doing things that will help increase the fees for the network, whether that is with something like an opcat to bring more functionality to the Bitcoin base layer itself, or building things like Babylon or Mizo and stuff like that?
So fees, I'm kind of a fee doomer, or actually an emission doomer. I actually think that the emission curve for Bitcoin could potentially be one of its existential threats. And, there have been proposals around increasing the emission curve, basically, adding more or less an infinite emission or something like that. I don't know if I go that far, but I do think that the emission curve for Bitcoin could potentially be its downfall. What that more tangibly means is maybe not this halving cycle, but like 4 or 5 halving cycles into the future, there's just not enough incentive for miners to go out and build all of this infrastructure to keep securing the network. So if hash rate starts to fall off, the network gets less secure. You kind of need a consistent hash rate growth over time. And in the white paper, and everybody's mind, and myself included, the fee revenue would start to offset the decrease in Bitcoin block subsidy. That has not been the case at all up to now. We actually did see, there was maybe a little bit of hope during Ordinals and Runes mania that maybe we accidentally solved the emission problem. But now fees are still sitting at 2 or 3 sats per VByte. And so as a miner, very interested in being involved in anything that could potentially introduce more L1 transaction activity, introducing more fees. So, some of the things that have introduced fees in the past, Ordinals and Runes, of course, those are, on-chain L1 assets. People interact with them in different ways. Ultimately, that drives up fee volume. The other, potential has been we've seen Babylon, which has definitely caused big fee spikes, and Mezzo and all these other, L2s that could potentially introduce big fee spikes getting across the bridge. But really, the missing component is opcat. So opcat is a new Bitcoin instruction that's built into Bitcoin Core. Basically, it allows you to build trustless bridges. I won't get into the details of that. Maybe I don't even understand them. Only a few people in the world do. But it allows you to build a trustless bridge. What's a trustless bridge? I can send Bitcoin to an address, and it can be monitored by a set of validators, and then I can get emitted some coin on a different chain trustlessly. Right now, that's done through Federation's pegnatory system, or just a straight up custodian. For example, WBTC is just custodied by a company that then emits the Ethereum WBTC on the other side. So if I want to mint a WBTC, I send some Bitcoin to this custodian. The custodian emits WBTC on the Ethereum chain. I move it around, do whatever I want to do. And if you want to redeem, you send WBTC back to the custodian. They burn it, and then you get your Bitcoin back, or you get 1 Bitcoin back. It's not your Bitcoin. In the case of opcap, you can do that trustlessly. I can send Bitcoin. A validator would then be able to emit Bitcoin on the other side. And then when somebody burns the Bitcoin or burns that WBTC or that wrapped Bitcoin, it comes back to you, but without any sort of intermediary. The reason people think this could introduce or bring a lot of transaction volume is because it could, you're basically more and more people are interacting with these trustless bridges. And so that's what opcat hopes to achieve. Will it? I don't know. As it pertains to whether opcat ever gets in, opcat requires a fork, and forks are really hard to get done. The last fork of Bitcoin was the Taproot upgrade, which introduced a new type of address and some new signatures, some new instructions around Taproot, and actually ultimately allowed Ordinals and Runes to exist, which made the maxis very angry. They don't like NFTs and fungible tokens other than Bitcoin. And so I think that we've ossified Bitcoin as a result. So I think the odds of opcat getting introduced are very low, actually in the near future. Maybe it gets introduced at a later time, but right now I think the odds of it getting introduced are very low. So we'll see. That could be a big, that would be a huge change to Bitcoin ecosystem, but I'm not sure if it's ever going to get done.
Thanks a lot. Thank you so much, Nick, for your time. I wish, I had so many more questions, but I hope.
Let's do a follow-up. Happy to come back on. We can do a follow-up. And yeah, you can follow us on Twitter at Luxor. We talk about a lot of mining stuff on Twitter. We have a pretty good newsletter and blog if you want to learn more about mining. You can shoot me a DM on Twitter at #Bender. or you can, send me an email. I'm sure, if you want to talk mining, happy to talk mining with anybody at any point in time. So really appreciate you having me on. And yeah, let's do another one where we have, a little more time to go through the rest of the questions.
Thanks a lot, Nick. Thanks for the time.
Awesome. Thank you guys. Have a great rest of your day.